Next up, we have Jordan Eliseo from the Perth Mint joining us. He is the manager of listed products and investment research. And before we get started, perhaps there are a lot of people on the call. We've got over 1,000 people on the conference today. Jordan, what does your title mean? I love to uncover what titles mean.
Well, firstly, thanks for having me at the conference, Kerry. So my role, I suppose, essentially, as the name suggests, covers two areas. So the investment research part is talking to people like yourself and publishing content around developments in the precious metals markets, why investors may want to include some of their or allocate some of their portfolio to gold, silver, precious metals more generally. And then the listed products element of it, the Perth Mint obviously has a product listed on the ASX. The ticker code is PM Gold, which basically tracks the Australian dollar gold price. So it's one of the easier ways, I suppose, that investors, particularly if they're already buying shares, like some of the mining companies from presentations that are taking place at this conference. Well, if people are already investing in mining shares, but they also want some gold, they can invest in PM Gold via their brokerage account. So yeah, my role effectively, that's the remit that it covers.
Yeah, and actually, I guess that's an easy way if people are kind of worried about what to invest in, et cetera, et cetera. ASX PM Gold, I'll just put some cash in that and it tracks the Australian dollar gold price.
Spot on. Yeah, that's right.
So ladies and gentlemen, will do very well when the Aussie dollar goes a little bit south, but we don't know about that yet. But listen, let's talk about the elephant in the room as we speak this week. And it's been happening for the last month or so. The gold price has pulled back a little bit, probably over the last couple of months.
Yep.
And we all know that people get nervous. They all pile in when the gold price is going strong, and then they all jump out when the gold price weakens a little bit. It is probably at about a 4-month low at the moment as we speak. What do you put that down to, and should investors be nervous?
Look, I sort of, the primary thing that I put the correction down to is the market needing to work off all of the froth that had built up into August when the price went above $2,000 US for the first time. So if you think of the last 20 years for precious metals, and I'll mostly just talk US dollars for this element. Obviously the price has gone from under $300 to $2,000, right? So it's been an incredible run over that time. But there have been swings and roundabouts along the way, and there are periods where the market runs ahead of itself and then it needs to have a breather and just sort of consolidate. And so one of the things that's really interesting, and I've written a little bit about this and published it in various places, is if you were to look at the last 20 years for gold and you were to check where the spot price is trading today, and compare it to where the average of where it had been trading on the previous 200 days, you can sort of track that over time as a way of saying, well, is the price right now, has it run ahead of where it's been on average, or has it dropped below where it's been on average? Now in August, when the price went to, I think 2,067 was the all-time high in London. At that point, the price was trading roughly 20% above its all-time high, roughly 20% above the 200-day moving average. Now, that had only happened, I think, 4 times previously in the last 20 years. And on every single occasion that had happened, the market always fell over the next 3 to 4 months, and the average pullback was around 10%, which on a $2,000 gold price is basically $200 coming out of the price. So for that reason alone, in my view, we're very much seeing a textbook correction in gold, and the idea that it will pull back to somewhere in the vicinity of the sort of US $1,800 mark, and that might take 3 to 4 months to play out, is a perfectly healthy sign, and it's something that we've seen happen several times already over the last 20 years. And as I say, the last 20 years have been incredibly kind to gold market investors. So from if you're a long-term owner of gold like I am, and like many of our clients are, and I'm sure many people watching of this, I don't think there's any particular reason to panic. In fact, it's typically when everyone starts to get nervous that it tends to be a better time to buy. And typically when everyone's super euphoric tends to be the better time to sell. But that's not just for gold. That's for all asset classes.
Anything, yeah.
Yeah.
Do you think a bit of the pressure, and I like your explanation, but do you think maybe as well there's been a bit of pressure because the Bitcoin is the big one in the room, that's been on a tear. Do you think people might have been selling out of gold and going into the Bitcoin sector?
Look, at the margin, definitely. And yeah, Bitcoin is as popular now as gold was 3 months ago. So, maybe that's a bit of an indication of what might happen over the next 3 months. But look, only at the margin. I think the bigger thing is just that gold had run as far ahead of the 200-day moving average, and there was just so much exuberance in the gold space 3 months ago. It needed to correct, and there have been other factors as well. US real yields now they're still incredibly low and indeed negative in most cases. But if you look at the US 10-year, I think in August it was about minus 1.1%. Now it's closer to minus 80 basis points. And so, as a long-term investment, you're still a guaranteed loser, but real yields have risen, and that tends to cap gold prices, particularly in the aftermath of the election as well. We've seen huge optimism. It's like every Monday now there's a new announcement that there's another vaccine coming.
Yeah.
So I think all of those factors, play into why gold has corrected. The popularity of Bitcoin, I'm not denying that in any way, but I don't think it's actually had a huge impact on the gold price.
Earlier today, we heard from Jim Rickards, who was talking about holding gold, but he also said that now is the time to hold cash as well, so that when there are opportunities. Do you see that we are still living in volatile times, and that people who are listening to us today, this is a virtual gold conference, obviously we are focused on gold, but what's your view on holding cash as well as gold? And do you have percentages that you'd like to share with people? Because there's a number of people that are listening today that have never dipped their toe into the gold market, be it gold equities or physical gold.
Yeah. Look, not percentages that I feel it's appropriate to say, well, this is the number that people should have as a general rule. But it's interesting to hear that Jim has said that. And funnily enough, only a week or so ago, my partner and I were going through our own sort of family portfolio. And we have still very sizable cash allocations in our own, our SMSF, and also money outside of super. And that's because as much as a long-term asset, cash is horrible. It's losing real purchasing power. In the short term, it's incredibly valuable. And whenever you see dislocations in markets and markets come off, so let's use gold as an example, or I know a lot of people watching this webinar and conference will be interested in the gold miners. Now, some of the gold miners are off 20, 30% now, right, in the last couple of months or more. So, if you had cash, well, all other things being equal, you can buy 30% more stock than you could before. So for me personally, I don't see cash as being a great asset to own when you compare it to consumer goods, because it's just perpetually losing value against them at a not a particularly fast rate right now, but it is losing value. But yeah, as a holding in a portfolio to buy other assets when they fall, then of course it has that kind of optionality value and always will.
Yeah, and that's it. That's a very good point. And you bring up the point of cash losing value. There's a lot of talk, people like John Adams talking about, where are we? Are we inflation? Are we deflation? Are we stagflation? And, I'm looking at it and I see what I call stealth inflation. And I'd say it in a very simplistic way. In other words, you go and buy something from the supermarket that used to be a certain size and it's just got a little bit smaller, same price. That's what I call stealth inflation. We're in inflation, deflation, stagflation, and also what are some of those threats going forward and how can people, again, it's about growing and protecting your wealth.
Yeah, look, it's probably not going to, given I work in the gold industry and I suppose have a bit of a background or sympathy for sort of Austrian economics and the like, that, in a world of QE and the like, I'd sort of say inflation is the bigger threat. But I think you do have to consider the deflationary trends that do remain or that are still in place in the economy today. So obviously you've got aging population, so the demographics factor, technological investment, and everything that we're seeing in that space tends to be sort of deflationary right now. You also have a scenario where there's very little money velocity in the economy right now. So whilst we're creating lots of money, or central banks are creating lots of money, money is not sloshing around the economy very fast. So all of those things are kind of deflationary. On the other side to that, you've of course got QE, you've got zero or negative real interest rates. You've also now got supply chain issues post-COVID with companies wanting to sort of re-onshore production or sourcing of inputs, and you name it. So that can be an inflationary factor. But maybe if I could just do a little bit of a segue. One of the things that's really been interesting is that with COVID, everyone's talked about this K-shaped economic recovery where some sectors will do really well and others will continue to lag for potentially years to come. In many ways, that's actually what we've been seeing with inflation data over the last several years. So, if you look at, in Australia, the average inflation rate over the last 10 to 20 years has been almost bang on 2.5%.
Right.
But if you look at the inflation of, or the increase in prices for things like health, education, and housing, actually the inflation rate there is more like 4.5% to 5%. Whereas if you look at the inflation rate for things like recreation or household items, it's closer to sort of 1%-ish. So prices are increasing, they're just not increasing very much at all. So there's definitely inflation in goods and services prices in the economy today. But the other one, and I think this is by far the bigger threat, is the asset price inflation.
Yeah.
So, if you look at, let's use US equities as an example, and this is pre-COVID. So COVID has obviously, thrown everyone for a loop. But, back in 2009, you could buy $1 of company sales, S&P, we're talking the S&P 500 as a whole, you could buy $1 of company sales for 80 cents, right? By the end of 2019, that same $1 of company sales was costing, I think, $2.40, right? So if you just assume the S&P 500 was one company and it had made $1 of sales, right? Well, in 2009, you were buying that company for 80 cents. In 2019, you're having to pay $2.40 to buy that company. Now, that works out at an inflation rate of about 15% per annum.
Wow.
Right. So, and we could use, like, the bond market is an even better example because yields have dropped from, like if we use Australia, pre-GFC, a 10-year bond yielded you 7%. So if you wanted a comfortable retirement, you needed to build a portfolio of maybe 800 grand. Now, given yields are sub 1, you need a portfolio of $5 to $6 million to be able to enjoy that comfortable retirement. So the asset price inflation story is clearly the bigger risk to people being able to maintain or grow their standards of living.
So what would you suggest people do? There's a lot of volatility. I mean, I know you can't listen, and I've already said this earlier today.
Yeah.
This is not financial advice. These are our opinions. Make sure you do your own research, get your own financial advice. This is Jordan and I having a conversation. And what I like about Jordan is he's well versed in sort of the economics and his viewpoint, and he's a big proponent of holding gold as part of your portfolio, mainly because it protects your purchasing power over the long term, I would suggest. Now, if real asset prices are going up and the S&P is what you say, back in 2009, it was 80 cents, now it's $2.40. Do you think that that's overcooked and is due for a correction?
Well, history would tend to suggest there's a very significant risk of that. But of course, we're in an environment where interest rates are at zero, bonds are yielding less than zero, and money is being created. So you can also understand why investors are willing to now pay, let's say, $2.40 for a dollar of company sales, because the alternatives are similarly, whether we want to use the word unappealing or risky or sort of pick your word there, you get the point. So I think we're now in a world where, unfortunately, I mean, even let's be honest, even with gold, like in nominal terms, gold hit an all-time high this year, right? So, we're not back in 2003 when I was lucky enough to get started in this space and you could buy an ounce of gold for closer to 500 Australian dollars. You need 5 times that amount now. So nothing is cheap in absolute terms. So it's all about playing relativities now. Or measuring, an asset that you're going to put money into versus other assets, rather than measuring it versus cash, if that makes sense.
Yeah.
Yeah, and it's a very, very difficult time, whether you're a personal investor, whether you're a financial planner looking for clients, whether you're an institutional wealth manager. It's a difficult time to both protect, let alone grow wealth. Although, given the inflows we're seeing into equities right now, is interesting. This week we saw one of the biggest outflows of gold from gold ETFs, and I think one of the biggest inflows into equity market funds and ETFs on record. So clearly, at this particular moment, and again, this is very much vaccine related. Markets are feeling pretty euphoric. Yeah.
So do you look at psychology when it comes to looking at how markets both interact and get overblown a little bit? Is that market psychology of human beings can be very very silly at times because they chase the yield, they chase the up, and then they sell on the down.
Yeah, absolutely. And so if I think back to say 15 years ago. If I saw a slew of bullish headlines for gold in the media, I'd be like, "Yay, great, gold's going to go up. Everyone's saying it's going to go up." Now I feel more comfortable when I see negative headlines, and vice versa, feel more confident or more worried when I see all the bullish headlines come in. And again, it's not just gold related. It's it's any asset class. But as human beings, at the end of the day, greed and fear, they've always been with us, and they always will be. You sort of see that in terms of investment flows, you name it. People love to chase yesterday's or last year's winner, and they shun last year's loser, even if it now offers the best value or the lowest risk. So yeah, the psychology of markets is fascinating, and also ironically, or maybe not ironically, but it doesn't change either as well. Like it actually. You can almost set your clock to it in the sense that people will continue to react this way.
Absolutely. And Jordan, I'm sorry, it's only a 20-minute thing. We've got Rick Rule just waiting. And listen, you're as important as he is, but I'm on a very tight time schedule. We've got 1 minute. Last comments to those people listening right now. This is the virtual gold conference. Is gold something that they should be looking at even with this pullback in the price?
I'm certainly adding a little bit to my own positions on this pullback. I think if you are interested in gold, to protect wealth, hedge against inflation, all those reasons, none of them have gone away, even though the price has pulled back 10%. That's what I'll leave it at that.
Jordan Eliseo from the Perth Mint. And don't forget ASX PM Gold. Thank you so much for joining us today. Next up, ladies and gentlemen, we have Mr. Rick Rule. And then after that, it is the live Zoom networking event. Don't forget to register. Jordan Eliseo, thanks so much for joining us today.
Pleasure, Kerry. Thank you for having me.